Owning your own home. That's everybody's dream, isn't it? But it's such a daunting task buying your first property, something you've never done before, probably the biggest purchase you've ever made. It can be really daunting. And then once you get that home and that mortgage, focusing on everything you can do to pay off that home. You've probably got a 30-year mortgage, pay off that home, probably trying to beat that 30-year mortgage and shaving a few years off it, scrimping, saving, putting extra savings in, your bonuses, whatever you can do. It just seems like it's a real mountain to climb. And that can sometimes feel quite deflating. But what if I told you there was another way? What if there was a way that you could pay your home off much quicker than that? Maybe at least twice as fast as that 30 years. We're talking, 15 years or less. Well, you know what? There is. And if that interests you, well, hang around here with me for a bit and keep listening. So, hi, I'm Michael Sgarbossa. I've got a career in railway construction engineering and I'm a personal finance enthusiast. So, it's safe to say that I'm a busy guy and I have been for many years. And that's why I've started this channel, Save, Invest, and Grow Your Money. I've come here to help all the busy people out there be able to employ the simple, low risk, effective strategies for building wealth. And that's what I'm here to do, to share you along that journey, share with you everything that I've researched in personal finance over 20 plus years. The things that I've learned not to do, I'll share those with you. And the things that I believe are the most effective things for you to build wealth for you and your family. Anyway, so back to the today's video about paying off your mortgage faster. So one of the key things to pay off your mortgage faster is to build wealth. And one of the most effective ways to build wealth is using other people's money and getting leverage, and particularly around property. So that's investing money in assets that appreciate in value. So buying a house, houses over time appreciate in value. Getting a loan to buy a car, I don't think I've heard too many people selling a car for more than what they bought it for. It's certainly not something that appreciates in value unless it's some collectible or something like that. But that's a whole nother story. But here, what I'm referring to is investing in property. Okay. Now, typically here in Australia, around the capital city locations in Australia, property has grown over the long term at an average of about 7% per year. Now, what that means in real terms is it doubles about every 10 years. Okay. But that's an average rate. It's not every year it grows 7%. Some years it grows more, some years it grows less. Sometimes that doubling will happen a bit quicker than 10 years. Sometimes it'll happen a bit longer. It's just the way it goes. It's the way property cycles work. And typically with property cycles, the majority of that growth might happen in a few short years during that cycle. So you might have a 10-year cycle where that property doubles in value. But the majority of that growth might be over a 3 or 4 year period, and the rest of it might be a little bit flat, maybe even a little bit less, in the odd year like we're experiencing at the moment with the economics around us. But it's buying the right properties in the right areas at the right time. And you can actually beat that 7%. That's around, the median house price here in Australia around capital cities. But median is, sort of like an average in a way. And with averages, there's always things that underperform and there's things that beat the average as well. So with the right research and getting the right professionals on your side, you can absolutely buy property in the right areas that can beat that. So for instance, over the long term around the Australian capital cities, long-term growth is about 7%. But if you start to pick that apart a little bit and you just look at, say, the eastern seaboard cities of Brisbane, Sydney and Melbourne, those over that same long-term period, we're talking 30, 40 years, those markets have grown between 7.6 and 8.2%. So you can see already we're finding some markets within markets around those capital cities. And then within those capital cities itself, there are markets within markets. So if you buy smartly, you can actually really accelerate that growth, which is an awesome thing for your long-term wealth building and being able to pay off your home faster. Okay. So the key thing about paying off your home faster is building that wealth, getting that property growth, because what you build is equity. And what equity is the value in your home compared to how much you owe on it. So let's say you bought a home for, let's say, $600,000 a few years ago, and you've got a $450,000 mortgage on it. Now, and so that would mean that your equity, 600 minus 450, is about $150,000. Now let's fast forward a few years. That house is now worth $900,000. If you're only paying an interest-only loan, and I very much doubt that, if it's your residence, you'll be paying principal and interest, so that's paying down the balance of your loan. But let's just say it's still 450,000. Okay, 900,000 value. That's now 900 minus 450. That's $450,000 in equity, and that equity is what you can do to you can harvest that equity out of your property, and you can go and use that to invest in more property to absolutely build your wealth. And you can use that to then pay off your home faster. That's the whole point of this video today. So I'll just share my screen here. And the first part of this strategy is step number one is just buy a home as soon as you possibly can. Okay. So just if you're renting, stop renting. Rent money is dead money. You're never going to get that back. It's never going to give you any benefit whatsoever. As soon as you can, find a way to get your deposits and buy yourself a home. The quicker you can get in the market, the quicker you can be part of that property growth we have here in Australia that I've talked about. So when you do that, you want to get a mortgage as long as you possibly can. So we're typically talking 30 years here, okay? And there's a reason for this, so just bear with me. You want to put down as little as possible. So you want to have a small deposit as possible. Now, if it's your first home, there are really great incentives here in Australia for buying your first home. So firstly, there's the new home buyers grant you can get. The different state governments have different amounts of money that they give that. All their programs are a little bit different. There is also the first home super saver scheme. So now in Australia, as of the last couple of years, you can now dip into your super and pull some money out of there to buy your first property. Now, this is a bit of a polarizing argument. A lot of people argue, hey, don't dip into your super. That's for your retirement. That's for down the track. If you take that now, you're not going to have it for later. Well, you know what? Buying a property and holding onto that for the long term is building your wealth. That's actually building towards your retirement anyway. So I really don't have a problem with it because it'll enable you to get into the property market faster. And just go with a small deposit. Being if it's your residence and a first home buyer, you can get loans up to 95% loan to value. And what do I mean by that? That means you only need 5% of the value of the property as a deposit. So that means there's more money in your pocket. You'll have to pay mortgage lenders insurance, anything that's above 80% loan to value. So needing a 20% deposit, anything within that, lenders see you as a little bit of a risk. So they make you buy lenders mortgage insurance. And yes, it's a cost, but the growth of the property over the long term well outstrips the cost and will get you into your property quicker. Even waiting 1 year or a couple of years to have enough money to not pay that interest, you'd have lost the growth in that property, which is greater than the lender's mortgage insurance premium that you would pay. So it's a no-brainer to actually take that up. It's called leverage. It's another part of using other people's money to build your wealth. So and I would suggest take as much money as the bank or the lender would let you have, as long as, do the responsible thing, have a look at your outgoings, have a look at maybe what that looks like, have a bit of a buffer, and make sure you can meet those repayments. No one wants to default on a mortgage. That's very counterproductive. You don't want to do that. Absolutely not. So step two in this strategy is don't pay off your home loan. And I know that sounds really counterintuitive, but don't pay any extra off your home loan than you need to. Okay, so I know we've been brought up, we've been told, buy a house, pay off your home loan, own your home, and that's the dream. Yeah, absolutely, and that is still what we're going to achieve. We're going to do it a slightly different way, rather than scrimping and saving for 30 years or putting extra money in to try and carve a few years off that 30 years. We're going to carve a hell of a lot more off that 30 years. We're going to halve that at least. That's what we're aiming to do here. So any extra savings that you get, any bonuses from work, I know birthday money, $50 in a birthday card, as I see here in Australia, a couple of scratches you might win off. Whatever you get, don't put that into your mortgage. Have an offset account with your mortgage. Keep that money there, okay? Then you'll get the interest savings off that with your mortgage. Or alternatively, you can go and set up an index fund investment account. That's I really recommend doing that. You can get a higher growth return on your money. Yes, it does bring a few short-term risks if you want to use that money in the short term. That's something you would have to consider. I've done other videos on this, but Obviously index funds are sensitive to stock market performance, but over time, those challenges are less realized. So they're actually quite a low risk investment to grow your money over the long term. So there's some alternatives of where you could actually park your money. Now, I know you're probably thinking, this all seems a bit crazy. You're telling me not to pay down my debt. Well, when you're using money or using debt like mortgages or borrowing money to invest in an appreciating asset like a home, that's called good debt. You're using debt to make you more money. You're not using debt to buy consumer items like homes, jet skis, holidays that you're never ever going to get a return on. So let's just remember that, okay? Using other people's money is what we call leverage, and that is your biggest friend for wealth building. So I'm really harping on this. So once you've bought your own home, we've got a strategy around what we're going to do with your savings. Now it's time to sit back and watch the value of your property grow, because what we're looking for is that equity. We're looking for the value in your property to increase over and above your mortgage. That's going to build that equity, and we're going to use that equity. We're actually going to use that equity, and we're going to go and buy another property. That's right. We're going to go and buy your first investment property. So how you do this is you can ring up your bank, or if you've got a mortgage broker, you can get them to you. You can get your mortgage broker to do this for you as well. And you just basically say, "Hey, I've got all this equity in my home. I actually want to take some equity out of my home and make some investments. I want to invest and it's as simple as that. So you want an investment loan. So the key thing here is you only want to value to 80% to the value of borrow 80% to the value of your home. Okay. And why am I saying that? Because above 80%, you trigger that lender's mortgage insurance again. So now you've got a home, you're building equity. You don't really want to trigger that again and pay it for a second time. So it's good to get into the property initially to actually get that asset because you've got leverage and it's going to build wealth. But to then go and double down and get lender's mortgage insurance a second time on the same property just does not make sense. It's an extra expense that you don't really need to be dipping into. So that is, and that's the key thing, getting another investment, because now what that means, you've got two houses. You've got your home and your first investment property doubling in value on average every 10 years. And that's an incredible way to build your wealth. So what I'm going to do here is just now share you with a real example of what buying one investment property and how this works can really do for you. And I'm going to keep it real simple. I'm going to keep it conservative. I'm not going to make any allowances for paying down any loan principals whatsoever. So we're assuming an interest-only loan. It's likely on your own home, you will have principal interest, and you will be paying down some of that principal through your repayments. All that really means is you're developing yourself a little bit of extra equity. And I'm assuming that your investment property is going to be cash flow neutral. So it's not costing you money. Your expenses are equal to the income that you're getting from that property. But if you buy well, very quickly, you'll find that your investment property, after a few years, will go from neutral to cash flow positive, or even cash flow positive from the outset if you've bought really well. And not putting any of your savings into these properties as well. So you're using your savings to maybe invest in an index fund elsewhere. You're not using it to invest in the property. Now you can do, absolutely you can do, particularly for an investment property, but I'm just keeping it conservative for this example. Okay, so first and foremost, we got property one. That's your home. We're at year naught. That's the home that we're going to buy for ourselves. Okay. Now I'm being a bit realistic here because property prices in the major capital cities aren't cheap, even around the fringes. Sydney's pretty expensive, but Melbourne and Brisbane, you could easily buy yourself a really nice 4-bedroom, 2-bathroom home for $650,000. You're probably doing pretty well there. There are cheaper homes about. You could even opt to maybe buy a townhouse as your first property. I would probably not go and buy an apartment in a large apartment complex because of the high body corporate fees. But like a townhouse is okay, or even maybe an older property that's a bit cheaper. Just get yourself into the market. And if you have to, look at a few different options because of what you can afford, absolutely, I recommend doing that. So year naught, this is all based on a $650,000 property. 10% deposit I'm going to use here. So that's a $65,000 equity to start this property with a $585,000 loan. Okay. Now that property is going to start growing. So property one in year three, based on 7% a year, it would have grown enough for you to be able to take enough equity out of that property. So your equity loan will only take it up to 80% of the value. You can take that equity out. Now, let's say we're going to buy an investment property, just like your home, 4-bedroom, 2-bathroom. It's going to cost you $650,000. Now, going with a 10% deposit for that investment, you're going to need about $100,000 for the deposit, plus your stamp duty and your closing costs for any solicitor fees, and a little bit of buffer in there as well. Okay, so work on 100,000, that will have you covered. So you can see here on the red section, that is the little bit of extra equity that we're actually going to pull out of your home. So that's the $100,000 right there. We're going to take that $100,000 and we're going to use that as the deposit and the closing costs to buy property number two. This is our $650,000 home, $65,000 deposit, $585,000 loan. Okay, so here we are, happy days. We bought a home. 3 years later, we bought an investment property. We're really getting our wealth building in order and on the path to success. So let's fast forward a whole bunch of years, okay? And let's fast forward to year 16, I'm going to call it, because I've done some numbers here based on 7%. Now, year 16, that property would have well and truly increased in value, your home, but so is your investment property. And you can see here, there's a massive amount of equity in that investment property. So now at this point in time, that property has probably grown to about maybe $1.4 million in value. Okay. And you're going to have a heap of equity in here. Now, that equity is enough to cover the original $585,000 loan plus the $100,000 investment loan that you've got. So $685,000 borrowed on your home, and you've got more than $685,000 in equity, the green box here. So we're going to go sell this property. There's some extra allowance in here, like 25% extra allowance for some selling fees and a bit of buffer, and to pay your capital gains tax, because that's what happens when you sell a property of a big gain. You're going to have to pay that capital gains tax. We're going to take that green and we're going to pay off the blue and the red on your home. Voila. Okay, we don't own property two anymore, but your home is free and clear. You own the roof over your head. All you got to do is pay your water, your electricity, your internet, your gas if you've got it, and your rates and any maintenance costs. But you've got no more mortgage costs. You now own your home. So you can see here, this is a really simple way that instead of chugging away, not putting any extra payments in, going the full 30 years or trying to struggle and pay that down a bit and maybe knocking 3, 4, 5, 6 off that mortgage back to maybe 24 years. We've now got this down to 16 years. And I'm being ultra conservative here, guys. I know that you can do much better than this, right? This is what you call playing the money game to win. Sitting back, buying your home and trying to pay that off without getting any leverage, using any other investment properties, that's playing the game not to lose. We want to play the game to win. Otherwise, we'll just be like everyone else, okay? So this is all about changing your money mindset. And you can see the power here. You can see the power in what this creates. You can see the power of the leverage and the wealth it creates for you. Now, you don't have to stop here. You might just want to buy one investment property and be happy with this. You can actually scale this up, okay? You can wait a couple of more years from year 3, get more equity, buy another investment property and another, and you can scale this up. And then once you've got a few investment properties, you can sell them and pay your home off even quicker. Or you can do something a bit different. You can start to then continue to build that portfolio and not only pay your home off down the track, but also create yourself some passive income by paying off some of those investment properties as well. So owning a few investment properties free and clear. So the rent that comes in is now your income. So what happens then, you have a choice on how much you need to work. Maybe you can just decide to work part-time. Maybe you can get to the point that you don't even have to work at all. Maybe there's some sort of you've got different interests that you've been afraid to step into because you'll lose your income. This will give you that confidence to maybe go and look at life a bit differently and make a few different choices. So I hope I've really got you excited now about owning at least one investment property. Um, just come back on screen. I hope I've got you really excited about owning at least one investment property. I've got you excited about the power of leverage and what this can do and how this can create wealth for you. And I really hope that you've got great value out of this video today. And if you have, please like this video, please share it with other people you think would get great value out of this video. And the other thing I want to add right at the end here is also pick up on the links to this video. I've got some links there of where you can find me to watch my other videos. And I've also got a link to my website, michaelsgarbossa.com. In there, I've got a free PDF for you, which is a basic plan of how I went from no savings to buy my first investment property. All outlined there for you at a basic level. So you can go and download that for free and have a look at that. And I hope that really helps you on your path to building your family's finances, getting you some wealth success, and paying off your home faster. All right, so thank you very much. I've enjoyed spending my time here with you today. I hope you've enjoyed it as well, and I'll see you next week. Thank you. Bye for now.